Tom Lee, who has been the lone bull. You've got some more bulls in your corner lately, but Tom, the warnings don't bode well for earnings season.
That's right, Sarah. I mean, earnings are slowing because there's a lot of tightening working their way through the system, and companies, CEOs are cautious. And I think that the earnings warnings kind of stand in contrast to market perceptions that the labor market's so strong that the Fed has to keep really accelerating its hikes.
So what you're saying is that the economy is actually weaker than the Fed thinks?
Yeah, I mean, I'd say right now, the hard data that markets, when they think about the Fed and what they react to is reports like CPI or the employment report. But the soft surveys, whether it's the ISMs or it's the plethora of companies warning on earnings, when companies have reduced profits or top line challenges or operational expenses, they're not going to be hiring. So I think it's still going to be a case where the market is data dependent, watching every report. In next week's CPI is not an exception. But to me, the gap that's widening is the soft data, whether it's like the surveys or the Manheim Used Car Price Index, are showing a weakening of the inflationary pressures. But the hard data we're still seeing is showing the economy's quite stronger inflation side. So I think it's just going to be a matter of time where, the soft data is sort of anchoring where things are headed and the hard data just catches up.
But in the meantime, back to these earnings warnings and negativity, Tom, doesn't it make it harder to be bullish on the market if earnings expectations have to come down?
Yeah, I mean, it's a little bit of a race against time, Sarah, because earnings are coming down, and that's reflecting the effect of the economy slowing. But what's going to matter to markets because of positioning and really how equity allocations are playing out is really when the Fed decides that enough tightening's taken place. So I think you can still be in a situation where earnings are weakening and even expectations come down, but stocks are going to react to the change in risk premia. And that's going to be the day that investors really start to feel that the war on inflation is starting to, the tide is turning. And it doesn't mean the Fed has to pivot. It just has to be the cadence of data starts to look better. And you might ask, well, why does risk premium matter? Inflation and the risk of inflation is still one of the biggest tail risks for risk premia. And really getting ahead of that and, seeing progress on inflation is going to matter for compressing risk premium. And just I would add is, if you look at high yield spreads, which is kind of an important corollary and ancillary to how you look at market risk premium, high yield spreads aren't making new wides. They're actually narrower now than they were in June. So there is that divergence between equity and credit, and that's why some credit investors are becoming interested in owning credit. Well, that does actually mean stocks can catch up once the tide of inflation is visibly turning on the hard data.